Australian tax residency will be changing. And if you're a fan of this channel, you'd already know that by now. Today, I'll give you a quick update as to what's happening and also provide you with 5 countries that you can move to cease your Australian tax residency. As at the end of December 2023, we are yet to hear anything from the Treasury's consultation that opened up in July 2023. If you want to learn more about that consultation, I've linked a video I did in August 2023 below, in which I describe what has occurred. From that consultation process, Treasury asked tax practitioners and the general public what their thoughts were on the updated or proposed tax residency rules. And we put a submission, which I have not yet shared with you guys. So you can find that one below if you want to have a quick read about what we feel and what we submitted to Treasury. We can utilize double tax treaties to cease Australian tax residency. In instances where you're a tax resident of 2 countries and they share a double tax treaty, then you can go about and search up the residence article, normally article number 4, where you can see a tie-breaking provision which occurs when you become a tax resident of both jurisdictions. And it's not usually a good thing to be dual tax resident, hence why double tax treaties provide some relief in these instances. The tie-breaking provision, they are normally based on where you have a permanent home available to you, if you have habitual abode somewhere, where your personal and economic ties are closer, or if you have citizenships in those countries. And so each double tax treaty is unique. So if you got any questions, reach out and we'll be able to assist you with that one. While this is just an oversimplification and there are many nuances and other factors to consider, what the idea here is that you can cease Australian tax residency by way of a double tax treaty and not just based on domestic tax laws, which, as we mentioned before, are potentially changing. Portugal is the latest addition to the double tax treaty family that Australia has. It was just signed on the 30th of November 2023, a couple of weeks ago. While Portugal is not a traditionally low country, there is access to what's called the non-habitual residence program, which may provide you with significant tax relief for income earned from outside of Portugal. Singapore, with its robust banking system and stable economy, Singapore is an appealing destination for many, with personal tax rates capping at 22%, but also there being no tax on dividends or capital gains. Romania. I've spoken to several people recently who have moved there and absolutely love it. With a maximum personal tax rate of 10%, there is an amazing opportunity here to reduce and structure your overall taxes. United Kingdom. And while there are 4 countries here, they all abide by the same tax regime. And while the UK tax system is not a low tax system, one little nuance that you may not have considered is what's called the non-domiciled program. The non-domiciled program allows you to use the remittance-based tax system for up to 15 of 20 years. So you only pay tax on income within the UK or brought to the UK. So this can be an absolutely powerful strategy. The 5th jurisdiction is Ireland. Ireland is similar to the UK in the sense that it also has a non-domiciled program, which you can take advantage of. One aspect of Ireland that puts itself over the UK is their low tax corporate environment, with maximum corporate tax rate being 12.5%. If you have any questions relating to applications of double tax treaties or of Australian tax residency, please comment below or reach out. And if you want to learn about the importance of Australian tax residency, then watch this video here. Thank you.